So when I first even thought about investing, somebody told me about the rule of 72. What this is you take 72 and divide it by the rate of return that you anticipate on your investment. What it'll tell you is the amount of time it takes for your investment to double. So here's an example. If I anticipate a 7% rate of return, 72 divided by 7 approximately equals 10. So every 10 years, my money would double. Now I figured if I'm investing and I'm gonna be investing for the next 30 to 40 years, I'll have about 3 to 4 doubling events. 10,000 becomes 20, becomes 40, becomes 80, becomes 160. And it's just unbelievable how compounding interest can affect growth of your money. And this got me absolutely hooked. So today we're going to talk about how much you actually need to get started with investing. I'm Ian Group from Ian Builds Wealth, and I want to thank all of you for being here this week. I want to thank specifically the people who have subscribed. I've had a lot of new subscribers on my YouTube channel. I also had a lot of people that downloaded my free budget, which is located right there in the show notes. And when you sign up for my free budget or any of my online content, you're going to get access to my exclusive email list. Every week on Monday, I send my Money Tip Mondays email. You're gonna get 5 tips right to your inbox, practical tips, links to videos and different pieces of content that I send out. But the point is it's no fluff, value add, and you're gonna get that as a thank you just for signing up for whatever you downloaded. So thanks everybody who's new here. I wanna welcome you. And we've got a lot to cover today. So if we went back in time, investing was kind of complex. You needed a broker. You needed a minimum amount of money that you would need to keep with that broker on account. There were fees and different things for investing, and that made the market just not very accessible, but that doesn't exist anymore. You see, investing is as simple as downloading an app, and you could sign up for any of the big brokerages online today. There are 3 reasons actually which make investing incredibly accessible. Number 1, there are very low minimums. I can go online and open up a Fidelity account with only a few bucks. I might need to transfer a couple $100, but whatever it is, it's almost negligible. And number 2, there are no commissions or fees for trades anymore. If you're paying fees, you probably want to think about switching what you're doing, because pretty much everybody out there is allowing for fee-free trades. Now, 10 years ago, this would have been completely unheard of. Robinhood started to come to the scene though, and it really changed the game for everybody. Now, nobody pays fees. And the third piece of this is fractional shares. Fractional shares allows you to buy a portion of a single share of stock. So right now, take the S&P 500 index fund, VOO, which is Vanguard's S&P 500 index fund. The price of that as of this video is $358 a share. If you don't have $358 to buy a single share of that exchange traded fund, you can take $50 and buy a portion of it. You can take $100 and have approximately 0.25 shares. It's that simple. In today's world, there's almost no reason why you can't get started. If everything is so accessible, you might be wondering, how much money should I be investing? Well, there are 2 things you need to take into account when you consider how much you should be investing. Number 1 is debt. If you have high interest debt, I highly recommend that you do not think about investing right now. If your debt is 6% or below, okay, 6% might be a little high, but anything above that, if we compare it to an average annual return for that VOO that I just told you about, at 7%, you're going to be just breaking even. Anything above it, you're going to be spending more money in interest than you would be bringing in as a return on your investment. So I think it would be prudent, if you have high interest debt, to take a pause, focus on that, and use all of the good habits that you learn and that you acquire from paying off your debt to then reroute that money into investing. The second thing you have to look at is your discretionary income. Simple formula here. Your income minus expenses equals discretionary income. It's that amount that you have left over every month after all of your expenses. So if you find that you actually have some money left over, this is a really good opportunity to start investing. You can use that money to save for an emergency fund, to put it into a retirement-based account like a Roth IRA. You can even use that money to put into a taxable brokerage that you open through a platform like Fidelity. If you don't have money left over, if you don't have any discretionary income, that's okay. Not a lot of people do, but this is a sign to look at 2 things. Number 1, your income. If you could start generating some more money, if you could go ask for a raise or possibly even go get a side hustle to bring in extra money, you can use that to invest. You can also consider reducing your expenses, which might be difficult, but if you can audit your expenses and find some ways to remove some of those throughout throughout the month, it's possible that that might also free up some money for you to invest. All right, so we know investing is accessible. We know the equation now that we have to look at to determine how long should we be investing for, though. The best way by far, in my opinion, is for the long term and consistently. Think about when you want to retire and plan on investing for that long, maybe even beyond it. It might be fun for you, but as much as possible, be consistent and do it every month. That is going to yield the best possible results. You're going to take advantage of some of the highs, but also of the lows. That's how you're going to see consistent progress. And it's really the same with anything. If I wanted to learn a sport like golf, I would be on the golf course practicing every day as much as possible, but it's all about that consistency and repetition to see success. Now look, if you are just investing your extra money, maybe you're investing commissions or side hustle money, which might just be unpredictable, that's okay. Remember, you can only do what you can do. Give yourself a pat on the back for just trying and do your best here. I want to give you an example that will show you why investing for the long term is going to prove to be more beneficial than just putting some money away right now and then stopping. So let's just take an example where I was able to invest $100 a month for 2 years. So that's $1,200 a year, $2,400 over 2 years. Now, if I got that 7% rate of return each year, which is just an average return, by the way, and I stop after 2 years, that $2,400 isn't going to grow very much. At compounding at 7% year over year, it's going to be just under $2,500. But if I continue investing for 10 years, so now I've invested $1,200 a year for 10 years, that's $12,000 I've put into the market. At 7%, that money will have compounded to over $16,500. That's a big difference. And the longer we're invested, the more we're going to reap the benefits of having that money working for us. Right now is a really interesting time because we see the market in a bit of a decline. You might be wondering, maybe the market's down. Now is not the right time to invest. But think of it like this. You go to your favorite store every week to buy the same thing, right? And you love that thing. You know you're going to buy it now. You know you're going to buy it in the future. And right now, there happens to be a discount. Last year, you were buying that same thing. The prices were a little bit higher. But today, that thing is on discount. And you know that at least a year from now, maybe 2 years from now, the prices are going to be at least back to where they were, possibly even more. What would you do? That's an analogy for the stock market. And that's why a lot of investors continue to invest during downturns, because they're taking advantage of better pricing today that they know will likely be higher tomorrow. So we went over how much we should invest, how long we should keep our money invested for, how long we should be investing. But the last question is, where do we put all this money? What do we actually do? And there are a lot of ways to slice it, but I'm going to give you 3 different examples to help illustrate how you can take that extra money, that discretionary income, and put it to work. Now, we're going to talk about 3 of my friends, Jane, Peter, and Avery, okay? And we're going to assume all of them are gainfully employed. They have different salaries. They all have a 401k that's matched by their employers. They take advantage of it. They invest the minimum in their 401k. And now we're talking about money they have left over after expenses in cash. So let's talk about Jane. Jane is 30 years old. She comes home every month with $2,500. And after expenses, she has an extra $100 a month to invest. Jane decides to put that money into her Roth IRA. So in a Roth, you can contribute up to $6,000 per year, which will grow tax-free. Unlike a taxable brokerage account where when you ultimately sell that investment down the road, you'll pay tax on it. In a Roth, it grows without tax and you won't have to pay taxes on that money, which is eligible to be used at 59 and a half. When you're just under 60 years old, 59 and a half. So even though she doesn't max out her Roth, this still makes the most sense for her because she plans to retire at 60 years old. And so because Jane's 30 and she's going to continue to invest that $100 a month for 30 years. After 30 years, she's going to have seen that money grow to just over $113,000. $100. That's all it took. And it was able to grow to that much. Is that enough for retirement? You're probably sitting thinking it's definitely not, but I'm just using this as an example to illustrate how your money can grow and how you can do this if you don't have a lot of money right now. So maybe you are making more money and you want another example. Let's take Peter. He's 25 years old and he comes home with $5,000 every month before expenses. After expenses, he can invest $500 per month. So Peter knows that he can max out his Roth IRA. $500 a month times 12 is $6,000. That's the limit for a Roth. And that's what he decides to do. And because Peter's 25, he knows he wants to retire in 40 years at 65. So just by maxing his Roth every year, Peter's going to wind up with $1.2 million invested by the time he retires. Good job, Peter. Not bad. In the last example, we're going to take my friend Avery. She's 35 years old and she's just starting out. She comes home with a high salary, $10,000 per month, and can afford to invest $1,000 a month. So just like Peter, she decides to max out her Roth, $500 a month, $6,000 total for the year, but that still leaves her with another $500. She decides she wants some of that money to be accessible between now and retirement, so she decides to put that in a taxable brokerage account, which she can freely trade from and cash out if she wants to. She'll just have to pay the taxes, as opposed to any retirement accounts where there are restrictions to accessing that money. So she takes that other $500 and puts it in a taxable brokerage account on Fidelity. And she buys an index fund like the one I mentioned earlier on in the video that mirrors the S&P 500. Avery plans to work another 30 years, and by investing that $1,000 per month between her Roth and her taxable brokerage, that money will grow to a little bit more than $1.1 million. So we have three pretty different scenarios here, all with different outcomes based on how much and how long, but it's clear there are two conclusions we can make that provide the best results. Number one, start early, and number two, be consistent. Like I said before, Peter started 10 years before Avery, and even though he was investing half of what she was investing, 500 compared to 1,000, by the time they reached the same age, he fared off better than she did, even though she was investing more money. So these are all examples, but it's all meant to poke at the question, what can you do? How much discretionary income do you have? If you don't know, you can figure that out. Look at what you're spending every month. Track your expenses and audit them. Can you reduce them at all? Can you make some more money? All of the answers to these questions are going to dictate how much you can invest. Once you have those answers, the rest is up to you. Setting it up is easy, automating is simple, and as we see from the examples, if you just stick with it for the long term, you're going to see results. If you have any questions, leave them in the comments. I'm happy to answer anything. Thanks again for being here. If you like this video, please make sure to subscribe and go download my free budget. If you need some help organizing everything, it's there for you. It's free. And if you reach out to me, I'm happy to help answer any of your questions. You'll also get added to my email list. As I mentioned before, 5 value add tips every single week, totally free, exclusive for you. I will see you again next week. Thanks so much for being here. And remember, be smart out there. See ya.